Hello, Internet. My name is Ryan Ingram, and today I want to really explain why in these other videos I've always mentioned that I don't calculate for capital expenditures or repairs and maintenance when I'm analyzing a property and when I am recapping kind of the analysis of the property in one of these deals explained videos. And the reason for that is primarily because of two main principles, or it's really one principle that I have written twice on the board, and that's the law of large numbers or the law of averages. And all this really means is I think insurance is a really good example of this. If an insurance company only insures one car, then they can't possibly connect enough premium from that one car in order to pay out if that car is involved in a wreck or some liability lawsuit. Could you imagine if that one car hit somebody, caused extensive damages to that other vehicle, and even worse, put the driver or passenger in the hospital? So if you were paying what you're used to paying for auto insurance, lesser than or around $100 per month, and how many months would you have to collect in order to just break even in the event of that one wreck? Similarly, you can't possibly collect or budget for enough capital expenditures or repairs and maintenance from one property in order to appropriately sustain or not have deferred maintenance on that property. So let's say you have one rental property that you charge $800 per month for. Now, a lot of people use like 10% as a rule of thumb. So they say you should always save 10% of the gross rent amount for capital expenditures, and then maybe another 5 or 10% for repairs and maintenance. So let's just do 10% on both. So you're at $80 a month. You're at $80 a month for your CapEx, and then another $80 per month for repairs and maintenance. So that brings you to a grand total of $160 a month. Or let's forecast it out for an entire year and say that you collect $1,920 per year for the capital expenditures and the repairs and maintenance on one property. Let's say a new water heater is needed on your one property. That's what, $1,100? That could be as high as $1,400 depending on you have it in. If you have a guy and you could get it done for $600 or $850, great. But let's say, just for this argument, that we are paying $1,100 for a new water heater. Now, you've only got $820 left in order to sustain yourself for the rest of the year. Now let's say something happens with a toilet and you need to clean the drains and replace the toilet. Let's just say that's $350. So now you're at $470. During this time, you're probably going to start to panic because you only have $470 left for the rest of the year. So you're going to, just hope and wish that nothing has happened. And now let's say you have to replace the roof. That's $4,000. That's probably the example I should have started with because that would have whittled away the entire savings. Yeah, let's do that. So now you need a new roof. That's negative $4,000. And that's a good price on a roof. So now in 1 year, you've already depleted your capital expenditures and your repairs and maintenance budget. And you're already going to be sitting there with your fingers crossed, hoping that nothing happens to this property for the next 12 months, just so that you can start to break even on your budget. Now, how likely is that to happen? You're always going to have problems, and I do not believe that your capital expenditures or repairs and maintenance budget will ever be sufficient in order to cover these damages. Now, on the second hand, what I've heard people do is they want to set aside a certain reserve. So let's say you've got $5,000 in a separate account set aside specifically for this property, and each month or each year you're adding $1,920 to it. Well, you still run into the same problem. Sure, you started with enough reserves, but as soon as this roof happens, let's say the first year, this is your balance, but now you're minus $4,000. So now you've got $2,920 left instead of the negative. But at the same time, you're still going to run out of money because things are still going to happen to this property. Now, don't get me wrong, it's not necessarily bad to have a rental property, even though it's not going to be able to sustain itself from a cash flow perspective, because you're still going to get the appreciation. You're not going to get the cash flow really, but you're still going to have the tax benefits. And I mean, you're still going to be making a difference in the community by having a property here that isn't full of deferred maintenance or an eyesore to the community. So I most certainly still advocate that you have some rental properties instead of zero rental properties. But at the same time, my whole point is that you're never going to be able to budget enough to take care of one property. However, let's say you have 10 rental properties. And now, each month, you're getting $1,600 for your CapEx and repairs maintenance budget. Now you're able to replace a roof in 3 months' time rather than waiting for 2 years, right? So now let's say you have 100 rental properties. And you're collecting $16,000 a month. Well, now you're going to have months where some properties won't need anything. Sure, other properties will need tons of work. We just spent $16,000 on one property because the basement wall collapsed after just absolute torrential downpour of rain. Now, that was a groundwater issue that's been going on unbeknownst to us for a very long time. So we fixed the groundwater, and we also fixed the basement wall, had structural engineers out. That was tons of fun, but at the same time, the only reason that we were able to do that is because we are collecting enough money from all of the properties apart from this capital expenditures and repairs and maintenance budget in order to take care of that just via the cash flow from the other properties because of the law of large numbers or the law of averages. So once you pass a certain threshold, I personally believe that that number is 10. I think once you have 10 properties or more, the properties will be able to sustain themselves. But again, there's another asterisk that we need to talk about. Those properties would only be able to sustain themselves if and only if you are not taking any money from those properties to live off of. Once you incorporate your living expenses into these properties, then sure, you're not even going to be able to sustain yourself off of this $1,920 per year thing, right? So my brother and I, as we are building this rental property portfolio, we're not taking any money for ourselves, either from the cash flow or from any of the refinances that we're doing. We're currently putting all of the money right back into the business so that we can continue to grow. So because we aren't taking any money from the business, we don't budget for the capital expenditures or the repairs and maintenance because the cash flow is sufficient to sustain our portfolio because of the law of large numbers. Now, when my brother and I had fewer than 10 properties, it seemed like every month we were anticipating the end of the month getting here to figure out how much we had to dig into our own pockets in order to sustain this rental property portfolio that we're growing. But now we're in a sweet spot where the portfolio is sustaining itself just via the cash flow, and we're not having to contribute more money each month. Even better, the portfolio is aiding us in purchasing more rental properties. So in discussing this with another local investor, he challenged me on this, and he said, well, what happens when you and your brother do start taking money from the business? And sure, at that point, we're going to need to find some way to start calculating for the capital expenditures or the repairs and maintenance. However, until then, I just kind of bake it into all of the numbers based on these theories. But that begs the question, when are we going to start taking money out of the business? And I don't know. My brother and I originally started doing this because we sat down, talked to each other, and realized that at one time we're going to have more than 4 kids in college, and that's going to be really expensive. How in the world are we going to pay for that? This was our answer. We have 14 years until one of our kids enters college. So at that time, based on the law of large averages, at the rate that we're growing, we're going to be okay. We're going to be okay to start taking around 160, uh, what is it, 40 grand a year with 4 kids, so $160,000 a year out for college. It's going to be a big expenditure, but at the same time, that's why we're getting started now and building this so that when that time comes, we have the ability to not acquire properties, to start sustaining the properties themselves from the portfolio and still have money left over in order to give a good education for our kids. And that's, of course, assuming that if our kids want to go to college, instead of hopping on the bandwagon and help us build this sweet real estate portfolio. So now that that's explained, in the future videos, all I'm going to do is refer back to this video and say, check out the real reasons why I do not budget for CapEx or repairs and maintenance. I hope this is helpful. I look forward to hearing what you guys think. If you have rental properties, how do you go about budgeting for capital expenditures and repairs and maintenance? Do you agree that 10 properties seems to be that sweet spot where you no longer have to worry about it? Feel free to comment below. If you like this video, thought it was helpful, please like and subscribe. Look forward to seeing you guys next time. And as always, if you want anything to be discussed on this channel, let me know. Comment it, and I will be happy to give you my 2 cents. Can't wait to talk to you guys soon.